First of all, can I start by seconding what Mike said about ShareSoc? I'm personally a member of ShareSoc, and I think you do tremendous work in helping to further the interests of investors in the UK, and to support our needs, and really do everything you can to make our life as investors as easy as possible. And you're right. I was last here in October 2021. An awful lot of water under the bridge since then, but actually nothing much has changed, because I've just looked at the all share index and it's almost exactly where it was, almost to the point where it was in October 2021. So a lot has changed, obviously, including some horrendous events in Ukraine, and a completely different interest rate and inflationary environment, but the market has gone nowhere. So anyway, hopefully I'll be able to leave you by the end of today with some reasons to be cheerful in general, and some reasons to be cheerful hopefully about Witan. For the 71% of you that own Witan, I'll try not to upset you too much, and for the 29% of you who don't own Witan, hopefully I can give you some reasons why you might want to consider Witan as part of your portfolios. But obviously, I'm here to give you information rather than investment advice, as the note here says. So without further ado, I will move on to the meat of today's presentation. I'll aim to talk for about 20 odd minutes, to give lots of time for questions and observations, because I do remember that last time there were a number of questions, and so I want to be able to leave lots of time to answer them. For those of you that don't know Witan, what I would like to do to start with is just settle on this slide here, which introduces us, tells you a little bit about what we do and how we think about managing the portfolio to deliver the best possible returns for our shareholders. And Witan was established in 1909 as an investment vehicle to house the assets of one family. And whatever it is, 114 years later, we've got well over 20,000 investors. We're listed on the London Stock Exchange. We're one of the largest and oldest investment companies, and by virtue of our size, we're a member of the FTSE 250, so one of the more liquid investment companies traded on the London Stock Exchange. We are a diversified global equity fund, and we're unusual in that we adopt a multi-manager approach. So what does that mean? Well, Witan is independent and self-managed. It means that I and my colleagues are employed by Witan, not by a third-party fund manager. It means that we then look to appoint different managers to run different parts of our portfolio, each of whom has an area of specialism, so that when we blend those portfolios together, we end up with one portfolio that our shareholders own, that aims to deliver long-term returns, irrespective of the different trends that are going on in the underlying market. And obviously, because we're an equity fund, we can't insulate our shareholders from the ups and downs of the equity market, but hopefully we can deliver returns through the cycle, and avoid the peaks and troughs that we get sometimes with funds that are more specialist or more focused on various parts of the market, be it value or growth or quality or the like. As it says here, we are owned by and dedicated to our shareholders. We take this responsibility extremely seriously. In fact, not only are we owned by and dedicated to our shareholders, we're employed by our shareholders, unlike most investment trusts, because of the structure of the company. So we do believe that we're 100% aligned with our shareholders' interests. And in fact, I and my colleagues have significant personal investments in Witan. So we eat our own cooking, and we share your joy and we feel your pain when things are going well or not so well. As with most investment trusts, the strategy is set by our independent board of directors, and they retain oversight of that strategy and ensure that it's implemented correctly, but most importantly, they're there as your representatives. They ensure that everything that's done at Witan is done in the best interests of our shareholders. They do, of course, delegate a lot of day-to-day management of the company to us, the investment team, and to our colleagues on the operations and compliance side. And we retain oversight of those managers that we have appointed to run parts of the portfolio. And those are active portfolios. So they're not index funds, they are active portfolios that are run on a high conviction basis by managers who have the confidence to select a relatively small number of companies in each portfolio, so that when we add them all together, we end up with a portfolio that's that serves the purpose of our shareholders. It says here that our assets are held in segregated accounts, and you might say, so what? But we believe this is very important. So Witan is not a fund of funds. It's a multi-manager structure, which means that every single company, with the exception of some funds that we do own, and I'll go into those later, but every single company that we own is held in Witan's custody rather than through a fund. So, for example, if something was to happen in a portfolio company, we know exactly how many shares we own in that company at any point in time. We also get a lot of information about how our individual managers are trading their portfolios and how they're responding to events around the world in individual companies or more broadly. This gives us an awful lot of information about how skilled those managers are and how adaptable they are and how reliable they are. So it's an important point, even though it might not seem like such an important point on the surface. Moving on. So when we put those together, this is what we end up with, the structure of Witan. As I say, we've got the board of directors at the top there. And in fact, really at the top should be the shareholders, but we don't have a box for the shareholders. We've got the shareholders at the top. The board represents them, and they delegate to us, the investment team. The portfolio is split across 8 different portfolio managers as we speak. Each of those portfolio managers will have their own in-house investment teams and teams of analysts that will be working tirelessly to identify good investment opportunities, and of course to monitor the investments that they currently have. When we put that all together, we end up with a portfolio which is valued at approximately 1.7 billion, slightly less than that today actually, because this was at the end of May, these numbers, with 8 portfolio managers. So what do we look for in a portfolio manager? We look for people with a long track record of delivering good returns over a long period through different investment cycles. We look for people that have a process that's applied with discipline, so that their investment returns are predictable. We like managers where their performance that they generate is performance that suits the type of market that we expect them to perform in. We like people that tend to sit in independent fund management companies, so that they're in control of, and they're often also owners of those fund management companies, so that they're in control of their destiny. They don't have external shareholders trying to drive them to grow assets under management to reward external shareholders. So that we find that they are very much aligned with their clients, i.e. us, and our shareholders. So we put them together. That's 8 external managers. Between them, they own about 250 companies. That's roughly 30 companies per manager. So as you can see, quite concentrated portfolios. Those assets are spread across 33 countries around the world, although clearly there are some countries that have much greater representation in the portfolio, such as the US and the UK and some of the major European markets. Each of the 11 sectors around the world is represented, although some more than others, and I'll go into that in a bit more detail later on. And across those sectors, there are 60 different industries. So you can see a diversified portfolio, diversified by country, diversified by sector and by industry. And indeed, as I'll also show later, by style. So some value stocks, some growth stocks, which by design is there to allow a smoother ride through some of the turbulence in equity markets. And we have the specialist funds. Again, I'll talk about the specialist funds a little bit later. Putting all that all together, we end up with what's called an active share of 79%. So for those of you that don't know what an active share is, it's a measure of how different a portfolio is from the benchmark that it aims to outperform. An active share of 0 is an index fund, an index tracking fund, where it's exactly the same as the benchmark that it's measured against. An active share of 100 is totally different from the benchmark that it aims to outperform. So you can see here that although this is a diversified portfolio with lots of companies in it, it is still quite different from the benchmark that it aims to outperform. And that's important because outperformance is difficult to achieve if you look very like the benchmark that you're aiming to outperform. Of course, there's no guarantee that that difference delivers outperformance. It might also deliver underperformance, but obviously the aim is to select the right managers who select the right companies for that difference to be positive rather than negative. Just to put a bit more color on this, we think about Witan's portfolio, although it is one portfolio in the end, we think about it as two separate entities which combine to create the one portfolio. The core portfolio is made up of 6 of our investment managers. They typically invest in global developed market countries, in large and mega cap and sometimes mid cap companies. The list is there. There are 6 of them. 3 of the 6 are domiciled in the or based in the 2 of the 6 are based in the US and 4 in the UK. Just running through them very quickly. I'm really happy to take questions on any of the managers at the end. But just to give you a little bit of color as to what they do and what they add to the portfolio. You can see I'll go from kind of the highest growth, highest rated stocks through to the lowest in that order. Jennison is the first one on the list. In that case, they run a portfolio of high growth companies, which are typically based in consumer goods companies or software, tech, internet, those types of businesses. And they look for companies with a positively inflecting growth rate. So in other words, growth companies that are increasing growth over time. Next one on the list is WCM. They're also based in the US, but this time on the West Coast near Los Angeles. They look for quality companies with 2 specific attributes. One is that they have a strong competitive advantage, otherwise known as a moat. But they're looking for companies where the moat is continuing to expand. In other words, the barriers to entry to compete against these companies is getting higher rather than being maintained. So it gives them a very strong place in their respective markets that they're operating in. They also look for a very strong corporate culture. Again, a bit of a qualitative assessment of a company, but very important nonetheless. Lindsell Train, next on the list, sure needs no introduction. UK-based manager, I think really exemplifies our idea that we want managers that are run and controlled and owned by the people that manage the money, because they're absolutely aligned with the interests of their investors. Nick Train and Mike Lindsell work together to run this portfolio, which is a global equity portfolio invested in companies with resonant brands and durable long-term earnings. And then next one on the list is Veritas. Veritas is another manager that focuses on quality companies but has a strong eye on valuation. So they will be looking for specific levels of predicted future returns before investing in a company. And then finally, Lansdowne. Lansdowne's quite adaptable. At the moment, they have a portfolio that is quite heavily invested in value opportunities, companies that are capital intensive, sometimes cyclical businesses, and quite often at the moment domiciled in the UK. So for investors on the call that are heavily invested in the UK market, there is some solace to be taken that managers that are investing across the globe are finding opportunities in the UK market to be more attractive relative to some of the opportunities that they're seeing elsewhere. So perhaps a little chink of light there for long-suffering investors in the UK market that have suffered pretty mediocre returns relative to global equities over the long run. And talking about the UK market, Artemis is the last one in our core portfolio. They do run a UK equity portfolio for us, focused on special situations where companies are going through a period of being out of favor for whatever reason, perhaps in need of management change or reshaping the business, but companies that only require self-help. So not companies that are reliant on a change in the landscape or the investment environment around them to have a turnaround. So companies that can help themselves is what they look for. As you'll see here, that's the core portfolio. Major companies, developed markets. There is a recognition that there are lots of opportunities outside major companies in developed markets, and that's where we have the specialist portfolio. 3 different managers in this portfolio. GQG run an emerging market portfolio for us. GMO run what's called a climate change strategy, which looks to invest in companies that benefits from efforts to mitigate or adapt to climate change. And then, as you can see here, Witan Investment Trust, that's us, the in-house team that is responsible for the selection of those dozen specialist funds that I mentioned earlier. Just to give you some examples of what sits within these portfolios, I won't go into any detail here in the interest of time, but lots of the names that sit in the core portfolio, I'm sure you'll all recognise, from UK companies such as Unilever, Diageo, BP, to European major European brands like Heineken and LVMH, and then of course some of the majors in the US like Google, Microsoft, Amazon, and Thermo Fisher Scientific and United Healthcare. The specialist portfolio, you can see here where some companies which you wouldn't find on the normal radar tend to crop up. So Solar Edge is a maker of technologies behind solar power generation. Vestas Wind Systems, obviously involved in wind turbines, and then some emerging market companies, TSMC, one of the biggest semiconductor manufacturers, and then a couple of Indian names in the portfolio as well. Darling Industries is quite an interesting one. That's a company with a 100-year history or more, doing very much today what is in vogue today, but has been doing it for a very long time, and that is taking waste product from the food and agriculture industry and converting it into biofuels, pet foods, and the like. So sort of recycling waste product from the food and agriculture industry. 2 of the names on the list there, Syncona and Victory Hill, the BH Global Sustainable Energy Opportunities. Those are 2 specialist funds that sit within the specialist funds portfolio, which I am about to come on to. And here's the portfolio breakdown shown in 3 different ways. On the left-hand side, by geography, the US is clearly the largest exposure that we have by country. Actually, it's North America here, but Canada's a couple of %, with the US being the balance. That's about a third of Witan's portfolio, with Europe and the UK roughly equally weighted at about 20% each, and the balance in Asia, Japan, and other emerging markets, primarily Latin America. Sector-wise, a pretty even split across sectors across the world. Smallish allocation to energy, and in fact our allocation to real estate and utilities is so low that it doesn't show on the chart. I think we have 1 company in each of those categories, making up way less than the half of 1% of the portfolio, so it doesn't show up on the charts here. And as I said earlier, our split between stocks that are classified as value stocks and those that are classified as growth stocks is roughly equally weighted at the moment, but that can change over time. You'll notice that all 3 pie charts have a section saying investment companies. We put it in as investment companies because it's difficult to split out what their underlying exposure is, but what we thought we would do here is give you a bit more information on those investment companies that we're invested in. The idea behind this portfolio is to take advantage of areas in the investment universe that our other 8 managers wouldn't typically be able to invest in, either through limits on their investment mandate, so in other words, private equity, for example, that they can't invest in, or because they're so specialist that they fall outside the skill set of generalist equity managers around the world. So the largest proportion, just over 50% of this portfolio, which is about 6 or 7% of Witan's total portfolio, is invested in private equity. And we get access to private equity primarily through listed private equity vehicles. That means private equity funds that are listed on the stock exchange. One of the benefits of that is that they are liquid, so we can deal in them every day rather than being locked up for many years, and being unable to, or being at the being at the behest of the private equity manager, either for calling down further investment or indeed waiting for realization. So the fact that we own listed private equity vehicles means that we have liquidity to respond to market environments. And also you'll see the column on the right hand side of this page which says discount. That's the discounts to net asset value on which these funds currently trade, or traded at the end of May. So you can see in the case of HarbourVest that we bought recently, that's trading at about a 42% discount to its net asset value. We actually bought it closer to a 50% discount to its net asset value. So you can see a lot of these private equity vehicles are very cheaply rated at the moment, and we believe this offers us long-term benefits to being invested at the current time, as some of the uncertainty dissipates over the months and years ahead, and these valuations trade closer to asset value. Of course, there's no guarantee that will happen, but that's our belief that it will. The next section is life sciences. Biotechnology has gone through a pretty tricky time in the listed investment market in the last year or two. We think it's the right time to be increasing exposure to biotechnology and life sciences in general. And so we're slowly building up exposure there. And really this is a play on the rate at which drug technology is advancing, and indeed the addressable market is growing as we all live longer. And then two other investments of note is in what we've sort of vaguely termed as infrastructure. I mentioned a little earlier this investment in VH Global Sustainable Energy Opportunities. It's a mid-market infrastructure developer that builds and runs renewable and sustainable energy projects around the world. They've got investments in Brazil, in the US, in Australia, and in the UK, both in hydropower, in clean fuels, in solar power generation and storage, as well as carbon capture and storage. So a diverse set of sustainable energy projects. We think there's great mileage in funding and benefiting from investment in efforts to build out a renewable energy infrastructure, and hence our retention of our holding in BlackRock World Mining, which we've owned really from 2014, initially as a play on the recovery in the commodity cycle at that time. But actually there's a strong argument these days that to build out a renewable energy grid of the scale that will be required to hit net zero over the long run will require an awful lot of mined materials, and World Mining sits squarely in that area. Just moving on. Obviously, we expect the portfolio that I've just been talking about to be the key driver of net asset value and therefore share price total return for our investors. But we have other levers that we can pull to help generate additional performance, and some of them are listed here on this slide. One of them is gearing. We do employ gearing, modest levels of gearing, I might add, and hopefully appropriate for market conditions. Typically our gearing will be somewhere in the region of high single digits to mid double digits. So in other words, 5, 6, 7% through to about 15%. We're currently geared at 15%. And our gearing takes two forms. So if we borrow money to invest, and the money that we borrowed takes two forms. One of them is fixed rates, long-term fixed rate debt. Think of them as bonds that are issued by Witan. They're not actually bonds. They're called private placement notes that are issued to pension funds and to insurance companies that were looking to match liabilities. in the days as long ago as last year, where liability matching was all in vogue. So this is a very long-term paper that goes out to 2054. And the average maturity is to 2049. And we're paying a princely sum of just under 3% for this money. So we're borrowing at significantly less than the UK government is currently having to pay to borrow money in the gilt market. And we believe that this is very advantageous to our shareholders to be able to rely on this this fixed rate long-term borrowing for the next couple of decades. But obviously we also want flexibility, because fixed rate borrowing is inflexible. So flexibility comes through the employment of short-term borrowing, bank borrowings, which until fairly recently was cheaper than our fixed rate debt, but now obviously it's more expensive because bank rates have gone up so dramatically. Another way we can help shareholders to boost returns is through our discount control mechanism. And I apologize, I failed to put in a slide showing our discount now and its history, but right now as we speak, the discount is about 10%. So our shares are trading at a 10% discount to asset value. That means that we are currently buying back shares at that level, because we believe it's an attractive valuation on which to enter into Witan shares. And for every share that we buy, there's an uplift for shareholders remaining. And just to put a quantity on that, last year we bought back nearly 8% of the shares outstanding at about an 8% discount to asset value, which created an uplift in monetary terms for the remaining shareholders of about £11 million, which offset all of the fees that we pay to our external fund managers, plus some of the running costs of Witan. So there's a tangible benefit to buying shares back when they're trading at a discount to asset value. We can also alter or adjust our asset allocation without interfering with manager portfolios. We do this using ETFs sometimes, and we also sometimes use index futures as a short-term measure to vary asset allocation. And we've done this sparingly from time to time. Normally, we're pretty happy with the allocation that drops out of the stock selection of our outsourced managers, but sometimes we want to adjust that. And we'll do that using ETFs and derivatives. And finally, one of the great benefits of being an investment trust is the ability to put away excess revenues earned in good years, so that during difficult years we're able to continue to pay a progressive dividend. And we think it's very important, because the majority of our shareholders are private individuals who in some way or other rely on dividends that come from their investment portfolios. And the chart here will just give you an idea as to how beneficial this has been for Witan and for its shareholders. Now, I don't want to overplay the ability to have a revenue reserve to sustain dividend growth over the long run, because obviously dividend growth is dependent on the quality of the companies that we own in the portfolio and their ability to pay increasing dividends over time. But what it does do is it helps insulate our shareholders from periods like this in COVID. And you can see here the green line is the dividend payout by the FTSE All Share, and there was a dramatic decrease in the dividend paid by the FTSE All Share, and indeed by other markets around the world. But because we had built up significant revenue reserves leading up to COVID, we were able to continue paying out an increasing dividend, irrespective of what was happening underneath in the portfolio. Now, obviously, if that situation was to have gone on for many years, the revenue reserves that we had would have been depleted. And so we do also have the ability to use capital to maintain the dividend, but it's not something that we would do lightly or indeed for a prolonged period. But we do believe that the structure of Witan's as an investment trust and the structure of our portfolio will enable us to continue to grow the dividend each year, as we've done here over the last 48 years since 1974. So you can see that the dividend in 1974 to today, it's roughly 70 times what it was in 1974. By way of comparison, the FTSE All-Share has grown dividends by less than 20 times. So significant outperformance in terms of dividend growth of our most obvious comparator market. And obviously inflation is all the talk at the moment, but even with the most recent uptick in inflation, inflation is way behind in terms of about 10 times. Prices roughly 10 times where they were in 1974. So dividend growth significantly outstripping inflation and indeed the UK market. Just a brief word on our responsible investment policy. We do believe that owning good quality companies, well managed, sustainable companies with sustainable cash flows is the anchor to generating good returns for our shareholders, and that it also goes hand in hand with our responsibility and our commitment to reach net zero from our portfolio over the long term, and for the benefit of the planet and indeed wider society. So companies which that behave in that way are likely to benefit financially over the long run, and hence we put in a strategy which aims to have a portfolio which by 2030 is full of sustainable companies by our definition. What it is not is a policy to exclude companies from our portfolio. We believe that investing in companies that are on the right trajectory and helping them to improve over time will create financial benefits to our shareholders and indeed benefits to wider society. So a kind of symbiotic relationship there between companies that are well managed and that have sustainable earnings versus those that are not well managed, and those which operate against the norms expected by society, which will suffer financially. So, you know, whilst this is a policy which takes into account our place in the world, it's also a policy which we believe benefits wholeheartedly the total returns expected by our shareholders. And I won't go through this slide, but this states out in more detail what it is that we look for in each of under each of these headings for companies that we invest in. But I mean, really, it's pretty much common sense. They're companies which have sustainable cash flows, which exhibit good corporate behavior, run by solid management teams that are operating to the benefit of their shareholders, their customers, and wider society, and also those that are prepared to work in partnership with other stakeholders to improve the operating capabilities and footprints of companies around the world. And so to finish at this stage, to stress that, you know, our purpose is to achieve significant growth in our investors' wealth. We do this aiming to increase capital and income over the long term, income ahead of inflation over the long term. Obviously, with years like this year, it might be unwise to try to increase the dividend to match annual inflation numbers, but over the long run, as you can see from the slide I showed previously, our dividend growth has significantly outstripped inflation. And I guess the chart here shows that, like all equity investment, it's not a straight line. So long-term investment mindset is required to invest in equities, because there are times where volatility will lead to drawdowns in particular years. But over the long run, equities have tended to generate returns of 6%, 7%, 8%, and in 3/4 of all years the market has been up. So I think the trend is your friend in this case. So long-term investment in equities through a global diversified approach, we believe, is the way to achieve significant growth in our investors' wealth over time. So with that, I do have one more page on the outlook, but rather than going through the outlook, I think what I might do is stop there and open it to questions. And I'm sure some of the questions might be on the outlooks, and so and if not, then I can obviously come back to this.
Okay, thank you, James. Well, we can just leave the outlook slide there for now whilst we discuss the questions. Just a reminder, if you have any questions for James, just type them into the Q&A box and we shall deal with them as they come in. We've got the princely number of 1 at the moment, questions, so there's plenty of space for other people. I've written down a few questions myself as you've been talking, James, so if nobody nips in before me, I will ask 1 or 2 of those. One here from Roy Colbrand. You've continued Harry Henderson's policy of aggressive buying back to control the discount, yet the overnight discount is shown in the FT at around 10.4% at the moment. So what has this enormous reduction in your equity in issue achieved?
Well, I think, I mean, there are various answers to this question. And I think the first answer is it's important to recognize that buying shares back is not wholly about controlling the discount. I think the discount is what is the share price that is set by the market, taking into account all market inputs, and that might well be, obviously, as we see at the moment, the inflation and interest rate environment is obviously negative for investor sentiment. We're seeing discounts wide across the investment trust world, and so obviously we sit in a peer group of similar trusts, and indeed a peer group of trusts that are a bit different from us, and across the landscape discounts have widened. So I suppose the short answer to the question is, what it has done is provided significant net asset value uplift for shareholders that remain. Secondly, whilst it hasn't limited the discounts at the moment, because we're currently trading at a 10% discount, as you suggest, it certainly reduced the discount volatility that might well have otherwise been there had we not been buying shares back. And I think also it sends a very strong signal to shareholders and to potential shareholders that we as the investment team, and indeed as the board, who are responsible obviously for the implementation of the discount or of the share buybacks, believes that Witan shares are attractive at the level at which they're buying them.
Right, thank you, James. Another question here from Alistair Grant. So where do you see the optimum prudent dividend yield for investment vehicles in your category, i.e. worldwide growth and income?
Yeah, good question. And I think there's been quite a lot of debate on this subject. I would say the prudent dividend yield on an investment company in our sector is not dissimilar to the yield that the portfolio generates. So in other words, the dividend that you're paying out is similar to the dividend that you're paying out is similar to the earnings that you're receiving. So in other words, that you're not distributing or artificially distributing capital as income. And people take a different view from me. Some people think that it's, you can earn 1% on your portfolio and pay a 4% dividend. I don't necessarily agree with that, because paying out capital as income creates perhaps an unnecessary tax bill for some shareholders. I think it's much better to have a steady state where your payout is covered by current year earnings, if possible.
Okay. And in recent times, what sectors have been generating the most earnings for you out of your portfolio as it stands?
A lot of the most sustainable earnings have come from sectors that you might imagine that are kind of most resilient and most predictable. So there's been some really good earnings, for example, coming out of the sort of high-end luxury branded goods companies. Some of the higher quality industrial names, and in fact, counterintuitively, some of the earnings that are predicted to grow most in the months and years ahead are some of those that are in the most cheaply rated companies. So in other words, companies that have gone through a period of poor performance because they've been cyclically exposed, but where earnings are looking to recover. So those are companies, for example, that might have been hit quite badly during COVID. So their earnings are coming up from quite a low base. So those are parts of the portfolio where we're seeing some quite strong earnings growth starting to come through. Where else? And well, the other area really where earnings are very strong has been a lot of these technology companies where there's been an awful lot of interest particularly in the last few months on the back of the quite extreme excitement surrounding generative AI. And I mean, obviously there are two different types of company, or two broad definitions of company within that space. You've got pre-profit growth companies, where obviously we're not seeing much earnings growth at all, if any, because they're pre-profit. But some of the more established businesses where growth has come through and is predicted to come through even more strongly as they benefit from the long runway to this quite exciting new technology. But I'm not going to sit here and say that these are something that's going to happen overnight, because obviously we're still some way from the monetization of artificial intelligence.
Okay. Roy Colbrand's come back to you about your earlier statement on managing the discount. I hear what you say, says Roy, but since the process started, the equity in issue has been reduced to well below 40% of what it was originally.
That's right. Yeah.
And how much further are you prepared to go? Down to one share?
I think I had this question last time I was on, actually.
Is that right? Okay.
It starts to ring a bell. Yeah. I've forgotten what I was going to say now. I think, I mean, it speaks to, I think it very much speaks to the independence of Witan as well. Because we're not a fund management company that earns a management fee for the size of the fund that we run. I mean, obviously there are advantages to the scale, and potentially Witan would have been bigger had we not bought shares back. And I say potentially on purpose, by the way. Potentially we would have been bigger had we not bought shares back. But actually the most important thing for us as employees of Witan and for the board of Witan is the share price total return that our investors receive, not the size of the company that we run, because we're not rewarded for the size of the company that we run. We obviously receive a salary for the work that we do. So most important and foremost in our consideration is how best to generate the best possible share price total return for our investors. Now, obviously, the primary way to do that is to have the best possible portfolio performance. But if we can help boost that performance by buying shares back, we will. Will we go to one share? Hopefully not. And the reason I said the word potential is, don't forget that if we're buying shares back at a 10% discount, it's our shareholders who benefit from that 10% uplift in the process of buying and cancelling the shares, or putting them into treasury, actually. If something else was to happen, so in other words, if we didn't buy shares back and our discount was to widen, and somebody else came and bought the shares who might be, an aggressive sort of arbitrager, for example, so they might buy the shares at, let's say, a 12% discount, and then demand, if they bought enough, to be, bought out by the company at a very narrow discount. So who's benefiting in that scenario? Well, the person who's come and bought them and demanded an exit, not the shareholders. So I think first and foremost, we're very much focused on the best possible share price total return for investors, and I think it just helps do that.
When was the last time you issued new shares?
2015.
Right.
2015. So we traded at or it might have actually been, early 2016 actually. We traded at a premium to asset value through 2015 and early into 2016. And I think there's a significant debate about what impacts discounts and premiums. clearly one of the things that helps your rating in the market is your performance. And I think last time I spoke on a ShareSoc webinar, we'd gone through a period where we'd performed quite poorly versus our peers because we were incorrectly positioned for what turned out to be, the shutting down of global economies during COVID. I'm really pleased that over the last year or so, performance has picked up quite markedly versus our peer group.
Right.
So that we're hopeful, in the same way that it helped to narrow the discount and indeed lead us to trade at a premium in 2015 and 2016, the same can be repeated again if we continue to deliver the sorts of returns that we've delivered over the last 12 to 18 months. And I think really that's one of the key thing that we're focused on.
Okay.
Is continuing to deliver those returns so that helps to narrow the discount to asset value. But it's not going to do it well.
Thank you. The question here from David Grossman. Jennison and WCM have significantly underperformed their benchmarks. Are you content to retain them? And what would make you drop them?
Yeah. Well, my colleague always comes out with a really, I think, a kind of insightful comment, which I think just demonstrates the way we think about this. Is when you're driving a car, you tend to, well, at least hopefully you look through the windscreen at the road ahead rather than trying to drive it using the rear view mirror and looking at what has gone and what's gone past you. He says it obviously much clearer than I do. But I mean, and that's very much how we think about our managers. What do we expect from them in the months and years ahead, rather than what performance have we enjoyed or suffered since they were appointed. He's absolutely right to point out that Jennison and WCM have underperformed since we appointed them. When we appointed them with fewer assets than we would typically give to managers, because we were concerned at the time that the timing wasn't necessarily opportune. And my God, the right thing to have done would have been not to appoint them at all at the point we appointed them and waited for longer. But we did appoint them then. And we have added to them, both of them, over time. I am really pleased that we retained them, because Jennison in particular performed exceptionally badly last year relative to their benchmark and in absolute terms, because they owned a lot of high growth companies which were worst hit last year and going into the beginning of this year. But they are far, I mean, we haven't actually published the numbers yet because we only published the manager numbers at the half year stage and the full year stage. But bearing in mind we're only 3 days away from the end of the half year, I'm pretty confident that we're going to be able to be publishing numbers for Jennison and also for WCM that are markedly ahead of the benchmarks that they're aiming to outperform. So we've seen a really solid recovery in their performance. And I guess that goes back to the comments I made right at the beginning about what it is that we look for in managers. And one of the things we look for is predictability. In other words, is the performance that they generate predictable for the environment in which you're operating? And that's absolutely the case with these two, because this is an environment where we would be expecting them to outperform. And thankfully, they have very much delivered in 2023 to date. So I'm happy that we've retained them and that we didn't flinch when
we didn't.
Performance was going against.
I suppose then the subsidiary question was that in what circumstances would you drop a manager? And have you any examples where you've done so in recent times?
Yeah, absolutely. I mean, there are various reasons why you might drop a manager. There are some that are specific to the manager themselves, and some that are more to do with the shape of your portfolio and what you're trying to achieve, and what investment outcomes you're trying to position for. In terms of specific managers, so I mean, obvious ones would be a change in personnel, because most of the managers that we employ have very key individuals that are responsible for managing that portfolio. So if one of the lead managers was to leave any of our managers, we would be very quickly reviewing whether we wanted to retain our investment with that manager. And that's another advantage of having these segregated mandates I was talking about, because if you were invested in a fund, you might well find yourself in a position that you're fighting with lots of other investors to get out of a fund because the manager's left. We don't have to do that. We own the assets, so we can just give the assets to someone else to manage without having to queue up to get out of a fund. We have a 1-month notice period on most of our managers. So if anything untoward was to happen, I mean, I guess obvious example right now would be Odie, because he's all over the press, unfortunately.
Yeah.
That for us, that wouldn't be a problem because we own the assets, we can do something about it. So that would be one reason why we might sell a manager. Another might be that we're experiencing performance which is unexpected, good or bad. So, if you're bought into a manager that you believe is running a value portfolio and he's massively outperforming in an environment which is a sort of growth environment, that leads you to question whether they're doing what they say they should be doing. So unexpected performance would lead you to very much question whether you've got the right manager. So some of the things like, when we meet them on a regular basis, if they can't eloquently talk through, some of the positions in the portfolio, you start to question, their depth of knowledge. So that might be another one. But really, more broadly, it's do you expect them to, and it's human nature to look at past performance, because that does color your view on a manager. But really, the most important thing is, do you expect them to deliver returns for you in the future? And if not, then you might be looking for somebody else to replace them, or alternatively, you're looking to get exposure to a different theme or a different strategy, and somebody has to make way, and so it might be they're just the lowest hanging fruit.
Mm-hmm. How often are you rebalancing your asset allocation between managers?
We do it. I mean, obviously, buying shares back costs money, and we have to fund those share buybacks. And so periodically, I mean, we don't go to our managers every day and say, we've just spent £1 million on shares. Can we have £100,000 each, please?
Yeah.
But we periodically, and when I say periodically, it's every month or two, we'll look at the manager lineup and we'll say we need to raise a little bit of money across the portfolio. We'll either take a equal slice across the managers if we don't have a particular view on where we want to take the money from. But more typically, we'll look at one or two managers where either they're bigger managers where because of their degree of outperformance they've grown relative to the others, so we might take a little bit away from one or two of the bigger managers, or we might take some away from a manager where we've got less conviction. So naturally, we're rebalancing all the time. Going back to your comment about when did we last issue shares, I mean, obviously we had the opposite decision to make in 2015 and 2016, which was we've issued shares, where should we allocate the money to? But that's relatively small tweaking of exposure to managers. More typically, bigger rebalancing will happen when we've got a specific change in view that we want to represent. So in other words, when we appointed the two growth managers, Jennison and WCM, we took money from some of the other managers to fund that. So that's a more significant rebalancing of the manager lineup.
Okay.
But it doesn't happen very often. We try not to be too active in terms of turnover between managers, because it's disruptive. It's disruptive for us.
Yeah.
Their portfolios. It costs money to trade portfolios, so they're appointed for the long term.
So what's just speaking of that, what is your typical portfolio turnover in any given year?
Well, it varies from manager to manager. Typically, I mean, it could be anything from 30 to 50% across the portfolio.
Right.
Across the
really?
portfolio.
That sounds high. Yeah. Okay.
Yeah, but some of the managers were specifically appointed because they are quite adroit, and because they are operating in markets where we feel being able to respond to changing changing environment around them is actually quite important. So For example, the emerging market manager, GQG, has really quite high portfolio turnover because there are so many different inputs into investing in emerging markets that they need to be able to respond. Jennison has quite high portfolio turnover because they respond quite quickly to the changing fortunes and expectations of what are quite often very highly rated growth companies. And so, I mean, a great example of this would be Peloton, that they owned through the COVID crisis. And then there was an accident at Peloton where a child was injured. In fact, I think he might even have died. I can't remember the exact detail, but was injured on one of their treadmills. And so the manager picked up the phone immediately to the management of Peloton and said, right, what are you going to do about this? And they weren't very happy with the response that they got. And so they sold the whole position immediately because they were aware that it might be, I mean, this is really where ESG comes into play to a certain extent. They were worried that a poor level of governance and a management inability to recognize what could be a significant threat to the share price and to the reputation of the company would severely damage the share price. So they sold the whole position. And thankfully they did, because I think the stock went from about $90 down to, I can't remember what the low was. It was about 10, I think. It has subsequently recovered a little bit. So turnover, you don't necessarily demand high turnover, but sometimes turnover is a necessary evil. And thankfully it's becoming much cheaper these days to trade shares. So, high turnover used to be a real problem because you had very high dealing costs, whereas now dealing costs are very, very low. Unfortunately, in the UK, we still have to pay stamp duty when we buy shares. I can't see that's going to be top of our government's list of taxes to cut, unfortunately.
Right.
But we are unusual across the developed world in the taxes that we have to pay to trade shares. I mean, you don't have to do that in the US, for example.
Okay, well, thank you, James. We're all out of questions, so thank you very much for spending this last hour with us. And it was good to catch up with your latest developments, and hope to have you back maybe next year sometime, just to see how things are going.
And thank you very much for hosting the webinar today. It's been a real pleasure, and I hope that
You're welcome. You're welcome.